What's up, weekend warriors? Jacob Keen here, research analyst at Henssler Financial, trying to show you how to put some bang in your buck on another edition of Casual Finance Friday.
Get down, baby!
After my last video on cannabis, I thought I'd hit you guys with something sobering. The party does end. Throughout the course of time, economies and markets have gone through cycles. From expansion to exhaustion to contraction to recovery, these cycles have distinct phases. These mechanics are as close to a fundamental rule of economics as anything at this juncture. If anyone tells you otherwise, assume they're a flat earther. There's something innate in our collective humanity that creates behavioral biases in a market lending to herd-like momentum. Policymakers can affect this, but no asset or economy has been able to defy the inherent physics of mean reversion. Let's start here. The average return on US equities over the past century has been roughly 10%. However, if we look at the distribution of returns, we see a year with a return between 8 to 12% is actually relatively rare. What feeds into this is a natural mean reversion, but to a larger extent, market cycle. You see, market cycles can become detached from economic cycles, but are largely at the whims of fundamental economic growth. For instance, assume 3 to 4% GDP growth and throw in some leverage, and you get to 10% earnings growth. Lo and behold, the average return. If the equity market is up 20% and earnings growth is up 10, the market has become more expensive. Compound this over time, and what you end up with is a nice, clean market expansion just waiting for an exhaustion event. As it occurs, buyers are more willing to pay a premium, a higher price, over time, and this tends to be inverse to the length of time since the last risk event. Buyers may be decreasing cash positions and buying on margin, but ultimately, you get a mean reversion. The air gets let out of the balloon. Now, sometimes this catalyst is something like a geopolitical event, a major company failure. I'm looking at you, Lehman Brothers, or it could be something more systemic like a recession. But before getting into recessions, or specifically economic cycles, let's take a quick look at market cycles, which again, though timing is largely uncertain, is primarily driven by valuations. If we add up all the companies in the S&P 500 and we look at the price of the index versus their total revenues, their operating income, and their earnings per share, we get some ratios. For revenue, we use the price to sales ratio. Now, as you can see, we're towards the top end of historical market cycle highs there and well off the lows from before. It's one measure and one fairly strong indication we are late in the market cycle. Next measure, using operating earnings or EBITDA, we see a price to EBITDA, which is again towards prior cycle highs. You can compare it to the high made in 2000 at 10.8. Again, it's indicating a late cycle environment here. Finally, using EPS, everyone's favorite measure, we got a PE of 18.4 now. Not too bad, right? Well shy of the high made in 2000, which was almost 30. That was ridiculous. So maybe not so stretched, right? But one thing to keep in mind is the EPS in the PE. Price to earnings is the only measure that uses the number of shares as a divisor. So if companies buy back stock, it boosts EPS and reduces the PE, however inorganic that EPS growth may be. So the big takeaway here is market cycles play out as detachments from average valuations. That's to the upside and the downside. Right now, we're towards the top end of historic market cycles. So take a look back at the chart in the table. Get a basic glimpse of how we at Henssler capture these valuation cycles. This has been Jacob Keen, research analyst at Henssler Financial, signing off on a moderately casual Finance Friday. Thank you.